From credit cards to stablecoins, will fragmentation or convergence win? As regulatory clarity around digital payments begins to take shape, particularly with proposals like the Genius Act in the United States, the next era of money is being quietly forged in stablecoins. At first glance, the idea seems promising. Regulated institutions, both banks and fintechs, issue their own versions of digital dollars, fast, auditable, and programmable. But beneath the surface lies a deeper issue: too many stablecoins might just recreate the very fragmentation they're supposed to fix. The current system, consolidated convenience. Today's payment systems, while far from perfect, are at least unified from a merchant's perspective. Visa and MasterCard dominate global card networks, with a few outliers like American Express and Discover. This consolidation allows retailers and platforms to support a small number of networks and still serve nearly all customers. The merchant doesn't care if your card is from Chase or Citi, as long as it has a Visa logo, the system just works. The stablecoin shift, a new fragmentation. Now imagine a future where 20 different regulated entities each issue their own stablecoin. USDC, Circle. PYUSD, PayPal. JP Morgan Coin, JP Morgan. A future Wells Fargo USD. Regional banks issuing their own coins. Fintech-led stablecoins with unique chains. Each coin may be fully compliant, 1:1 backed, and technically sound, but will users adopt all of them? Will merchants support all of them? Probably not. Most consumers will gravitate toward one or two stablecoins that are easy to use, trusted, and widely accepted. Merchants, in turn, will only integrate what the majority of their customers use, just as many skip American Express due to lower usage or higher fees. In other words, stablecoin fragmentation could become the new credit card wars, just with 10x more complexity. Network effects, the hidden force behind dominance. When it comes to payments, network effects win. A payment method only becomes useful when enough people use it, both to pay and to receive. That's how Visa and MasterCard became giants. The same rules apply to stablecoins. A few dominant issuers will emerge based on regulatory approval and clarity, Genius compliant, FDIC backed, or Treasury secured. Strong integrations, Apple Pay, Shopify, Square, major exchanges, POS systems. Interoperability and chain support, Ethereum, Solana, L2S, or chain-agnostic wrappers. Brand trust and perception, which coins users believe are safest and most real. These winning stablecoins could eventually replace card networks altogether, enabling real-time, low-fee, programmable payments at the speed of software. Possible solutions to fragmentation. Even if many stablecoins exist, new infrastructure may emerge to abstract the mess away. Payment aggregators platforms like Stripe or Square could support stablecoin payments under the hood. Merchants just see dollars, users pick their coin. Interoperability protocols, cross-chain bridges or universal wallets may let any stablecoin be converted or wrapped into a commonly accepted format. CBDCs or public rails. The US may launch a Fed-backed digital dollar, reducing the need for 20 private versions. Ultimately, what wins isn't the number of coins, it's the experience and reliability of the system they plug into. BAFI, Bitcoin, BSV blockchain, as financial infrastructure, not a competitor. There's another path forward, one less discussed, but potentially more transformative. Unlike most of the crypto industry that wants to tear down the system, BSV blockchain has always positioned itself as a neutral, scalable ledger that traditional players can adopt without changing their role, just their plumbing. As Dr. Craig Wright has often said, Bitcoin isn't about replacing banks. It's about reducing the cost of trust. Under this vision, Visa doesn't die. It becomes lighter, faster, and cheaper. Banks don't vanish. They issue instruments anchored to a public audit trail. Regulators don't get sidelined. They get real-time visibility with immutable records. It's not disruption through destruction, it's disruption through seamless integration. Visa on BSV blockchain, a strategic fit? Let's explore the Visa on BSV blockchain concept. What Visa keeps? Brand trust. Merchant network. Customer onboarding. Business services and fraud protection. What Visa swaps out? Legacy rails with high fees, e.g., SWIFT, card clearing. Expensive hardware, chips, plastic, terminals. Closed settlement systems. What BSV blockchain provides? A single, global, low-cost settlement layer. Real-time micropayment infrastructure, fractions of a cent. QR code and wallet-based UX at scale. Immutable audit trails, usable for compliance, reporting, forensics. This setup enables Visa to transition into a Layer 2 service provider on top of BSV blockchain, just like Stripe runs on TCP/IP but adds value on top. In other words, BSV blockchain enables Visa to retain their business model, but slash costs and embrace the future. Stablecoins versus BSV blockchain, two visions, two futures. Payment stablecoins are often designed to replace credit cards. They bypass card networks. They enable direct P2P payments. They decentralize custody and settlement. BSV blockchain, on the other hand, is designed to power the incumbents, lowering their infrastructure costs, enhancing their transparency and auditability, letting them keep their business models while modernizing the back end. For legacy players like Visa, the BSV blockchain model is far less disruptive, and far more appealing. Conclusion: convergence is coming, but how? Your credit card might someday be replaced by a stable coin, or reimagined through a public ledger like BSV blockchain. The Genius Act may open the gates to competition, but it's network effects, not compliance alone, that will decide the winners. Over time, the chaos of many may converge into the dominance of a few, or be abstracted by technologies that let existing players ride the wave instead of being washed away. Stablecoins may aim to replace credit cards. BSV blockchain aims to power them. And that might be the smarter path forward, one where the financial giants don't get destroyed, but rebuilt from within.